Hi guys, welcome to our next recording. We're going to be looking at fair value measurement for this one. So let's get started. I'll just share my screen as always. So I'm just going to share that. And as I said, we're going to be talking about fair value accounting. Okay. I won't go through these learning objectives, but let's get to what we're going to be talking about. As you know, in our previous video, we talked about fair value. We said that we can use things like market values. Obviously, there's things to talk about, such as exit prices, what that means. And obviously, we've got issues around measurement. Okay. So we're going to be putting a little bit more detail into just fair value accounting for this session. Okay. So fair value appears in many different accounting standards. Business combinations, which some of you may have already studied. Financial instruments, which is highly complex. Property, plant, and equipment, some of you might have studied that. Revenue, impairment of assets, intangible assets. Financial instruments, again, it's got a couple of different standards that cover it. Investment properties, another one. So there's a whole long list, okay? Now, the usefulness of fair value as an economic measure is based on a couple of assumptions. And these come from the conceptual framework, i.e., fair value is justified given that allows us to measure the future economic benefit of an asset in dollar terms, and allows us to also measure fair values, the future economic sacrifice, so the obligation associated with a liability. And fair value is trying to capture the real value, the inherent value of the benefit or the sacrifice, the obligation. So let's have a look. The traditional definition says the amount for which an asset could be exchanged or a liability settled between knowledgeable, willing parties in an arm's length transaction, okay? The problem with that definition, okay, it does not really specify if the entity is buying or selling. And what does settling a liability mean? Does it mean paying the amount, or do we reach an agreement to pay a different amount? Okay, we don't know. At what stage do we measure the transaction? And what does willing mean? What happens if one of the parties is desperate? Does that mean it doesn't apply? Why would they be desperate? Because they could be they're having a financial crisis within their organization. Okay. So we've got IFRS 13, okay? And the objective is to establish a single source of guidance for all fair value measurements required or permitted, i.e., we want to have one standard that deals with the concept of fair value measurement, okay? It doesn't mean that the other standards which use fair value aren't relevant. No, we just want to have one standard that deals with the measurement aspects of fair value. We can still apply it in other standards. That's okay. So we want a single source of guidance. We want to clarify the definition of fair value and the guidance in the standard so that we have information that's communicated clearly, okay, and there's objective measurement, okay? We also want to enhance disclosures about fair values to enable users of financial statements to assess or make a judgment about the extent to which fair value is used, okay? And also understand what inputs were used in deriving those fair values, okay? In the past, yes, we've talked about fair value in different accounting standards, but before we had IFRS 13, you might have had accounting standards that treated fair value differently, or they might have even had slightly different definitions of fair value. So that wasn't really going to be a good outcome, okay? So, fair value measurement, when it's It's used when another IFRS requires or permits fair value measurement. So we use them together, but it excludes share-based payments, leasing transactions, okay, or any measurement that is similar to fair value but is not termed fair value. So it's not used 100% of the time, but like 95% of the time, okay? So that's good enough. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date, okay? All right, that would be received to sell an asset or paid to transfer in an orderly transaction. So that just means it's a usual transaction, okay? And it's not under duress or any of those sort of things normally. So with this in mind, okay, the transaction may be hypothetical. And what that means is that even when there is no observable market to provide information about the sale of an asset or the transfer of a liability, okay, we're going to assume that a fair value measurement takes place on that date, okay? So there may not be able to, there may be no observable market, but we can still make assumptions about the way this works, okay? So an exit price embodies expectations about the future cash flow inflows and outflows associated with the asset or liability from the perspective of the market participants, okay? So what that means, okay, it allows users to focus on the value today. If I sold it today, or if I had an exit value, or if I settled my liability today, how much would it be worth? It's not a historical price, because historical prices may not be really relevant, especially during times of inflation. It's also quite specific, okay? It focuses on the actual asset or liability at hand, rather than the price to purchase a generic equivalent. Now, the idea of purchasing a generic equivalent, that may not work because you might have some assets that are so specific to your industry, okay, that are so specific to your industry that there's no generic equivalent available, okay? It has a level of independence by the idea of hypothetically bringing an external party into the transaction, what it would be worth if that external party was involved in the transaction. Okay. Now, a transaction that assumes exposure to the market for a period before the measurement date to allow for marketing activities that are usual and customary for transactions involving such assets is not a forced transaction, okay? So if you're valuing land, okay, and you are able to value it based on an orderly transaction, i.e. you can market that for 6 weeks, and if you market that land for 6 weeks, which is the normal marketing time for a commercial land transaction, if you can market it for 6 weeks and arrive at what a market value would be, okay, that's orderly. But if you were saying to yourself, I need to sell this land tomorrow, I'll take whatever I can get, that's a forced transaction because you haven't gone through the usual process of exposing that asset for sale to the market. So there's a normal process, and that's part of having an orderly transaction. Okay. Now, what are the characteristics of the market? An inactive market would have few recent transactions. Price quotes are not developed using current information. Maybe the prices quoted would vary substantially, okay? Indices that previously were highly correlated with the fair values of assets, maybe they're uncorrelated these days. Okay, maybe they're uncorrelated these days. Okay, so there's a lot of things to consider. Okay, a lot of things to consider. An inactive market, the market's gone toxic. Maybe the product isn't even wanted anymore. Maybe people don't want that share, those shares in that company anymore, because it's involved in something that impacts on the environment. There's a wide bid-ask spread. So that's the difference between what a dealer is willing to buy and sell it for. A wide bid-ask spread implies two things. There's not enough market participants buying and selling in the market, or the risk is really high. There's a decline in the activity in the market, or little information is publicly available. Okay. Now, so what are the characteristics of the market? Okay. Is it really inactive? Okay. Now, the burden of proof here is to show that the market is inactive. Okay. So if it is an inactive market, you might have a market price, but you have to make adjustments. Okay. Or you might have to use some alternative valuation technique. So you might be looking at this, the market price of a share, but the last share sale was 3 months ago, because it's not a very common stock for people to buy and sell. That would be an inactive market. So a fair value measurement assumes that the transaction to sell the asset occurs in the principal or the most relevant market for the asset or liability, or if there's no principal market, in the most advantageous market, so an alternative market, but the entity must have access to that market. The fair value of the asset or liability shall be measured using the assumption that market participants would use in pricing the asset or liability. Okay, in developing these assumptions, we probably need to think about specific market participants. We need to identify, okay, what market participants there are in the market and what information they would use, okay, in pricing the asset or liability. A fair value measurement is for a particular asset or liability. Therefore, when measuring fair value, an entity should take into account the characteristics of the asset or liability. Okay, if market participants would take those characteristics into account when pricing the asset or liability. Okay, so what that means is that if the rest of the market is taking into account certain characteristics when measuring an asset or a liability, you need to do that as well. Okay, so the characteristics could relate to things like, what is the condition of the asset? Is it good or poor condition? Obviously, we take that into account. Or are there restrictions? So if it's a defense asset, for example, there might be restrictions in being able to sell it into a foreign market. Okay. A fair value measurement of a non-financial asset. Okay, so this is going to be property, plant, things like that, takes into account a market participant's ability to generate economic benefits by using the asset as its highest and best use, or by selling it to someone who would use the asset. So we're going to value the asset, okay, based on its expected future benefits, but we're going to value the asset on the assumption that it's going to be used efficiently to its best use, as opposed to not used and not generate any economic benefits. Okay. But there are some limitations. It must be physically possible. It must be legally permissible to use the asset in such a way, and it must be financially feasible. Okay. Now, fair value measurement assumes that a financial or non-financial liability of an entity's own equity instrument is transferred to a market participant, okay, at the measurement date, okay? So that's just part of the practice of how this works. Liabilities can be based on the corresponding asset, okay? So it says here, when public prices aren't available for the debt or equity, the entity should, where possible, measure the fair value of the liability or equity instrument from the perspective of a market participant that holds the identical item as an asset. So if I've got an accounts payable, someone else has got an accounts receivable for that amount. So what we're saying there is the value of our accounts payable, the liability, should be exactly the same as the other participant has valued the asset as an accounts receivable, okay? Sometimes there may not be a corresponding asset, say a liability associated with the decommissioning of a power plant, okay? Obviously, to do that, you'd measure the future cash outflows that you would need to incur to meet your financial obligations, okay, to decommission that power plant. That's fairly complex, okay? Fairly complex, but again, it's all about the fair value of the cash flows, whether coming in or out. That's the big part of what we're doing in this valuation, okay, in this subject. So there's a number of techniques that we can use for fair value. We can use the market approach, i.e. comparable market transactions. We can use the income approach, so the present value, perhaps, of the cash flows that are going to be generated by the asset. We can use the cost approach, so that could be the current replacement cost, or observable inputs are those values that can be obtained independently from available market data, possibly with some adjustment for the specific asset, which could be used by market participants. Unobservable inputs are based on information that is not available in the market, but we can estimate or infer what those numbers would be, okay? So when we come to all this, and this is probably the most important thing, I think, we come to what we call a fair value hierarchy. Level 1 is quoted prices that are not adjusted in active markets for identical assets or liabilities. So if I was trying to value a share, I could go into an active market called the ASX and see exactly how much that share was trading for. Okay, so I'm valuing CBA shares. If I've got bonds that I've issued, which are a liability, if I've got 5-year, semi-annual, 4% coupon bonds that expire in some time, I could have a look at what those bonds are also trading for that are identical. Okay. Level 2 are inputs other than quoted prices included within level 1 that are observable. So it might be a similar asset. Okay. Level 3 is based on unobservable market data. So we might have to use a cash flow, a PV methodology for that one. Okay. So an entity shall disclose information that helps users of its financial statements assess both the following, okay? It helps us assess whether liabilities that are measured at fair value on a assets or liabilities that are measured at a fair value on a recurring or non-occurring basis in the statement of financial position after initial recognition, okay? The valuation techniques and inputs used to develop these measurements. Okay, so they want you to tell us what techniques you've used and what inputs you have used. Okay. For recurring fair value measurements using significant unobservable inputs, i.e. level 3, okay, the effect of the measurement on the profit and loss of other comprehensive income must be recorded. The transaction costs are considered in determining which market value to use, okay. So they're an artifact of the market. You'll tend to find that the specific accounting standards will deal with transaction costs themselves. So for example, when we're looking at financial instruments, they look at transaction costs as part of the measurement process. Do I capitalize it or do I expense it straight away? Other issues include a block of assets. It could be an entity holding a high number of relatively rare assets. And if you were to sell them at the same time, that would flood the market, okay? And the share price would drop as a result, okay? So the blockage factor is not permitted, and we work out the fair value determined for each asset individually, okay? The fair value at initial recognition is different to cost, okay? We're using an exit price model and we're assuming that the entry price is equal to the exit, okay? If there's a difference, there's a gain or loss through the P&L. Now, one of the really important things, guys, is that we can use third-party valuations. But it's important, the standard lets us use them, it's important to evaluate who issued the quote, who the nature of the quote is it current? Are the assumptions made valid? And that could have implications for auditors. But having said that, if you're going to, value property, okay, and you're going to use a valuation company that has a robust methodology, it's well known and understood by the auditors, and this company has a reputation by being able to do the right thing, that's obviously going to be better than someone just guessing, okay, or estimating based on fairly crude assumptions. You tend to find that these third-party valuation companies, they're actually pretty good at estimating values, okay? And they have a robust methodology. So we've talked about the role of fair value. It is increasing. It is going to be more important. We talked about the traditional and the key aspects of the new definitions, what it means for assets and liabilities. We talked about some valuation techniques and the hierarchy there. And then we talked a little bit about disclosure, okay? Now, I'm just going to stop sharing my screen and I'm just going to come back, and while we're having a little bit of a chat, I'm just going to look up one thing, okay? Give me a second, but let's have a look at the disclosure here. I'm just going to, while we're talking, I'm going to look up the Qantas annual report for 2019. So just give me a second. Annual report, Qantas, yeah. I'm going to download it. And then we're going to share our screen, and I'm going to just drag this across. So I'm just going to drag this across for you, okay? I'm just going to drag this across. That's the Qantas annual report. You can see it. So I'm just going to share my screen again. Share my screen. So I'm just going to share this one. Share it. Okay, you can see what we're looking at there. I'm going to Command F. I'm just going to put in the word fair. Okay, and that really hasn't helped, but let's try fair value. And there's some examples there All right, so the word fair value is pretty important in this set of financial reports. I just want to go through the director's report because it's not as relevant to what we are looking at there. But I want to get back here. And I'm now, sorry, I went too far. I'm now in my financial statements, okay? So there's my statement of changes in equity. Okay, there's my balance sheet. Okay, now, if I come up here, there's probably going to be an index, okay? In the index, I'm just going to have a look here. No, it's not there. Okay. All right. So let's go consolidated statement of changes in equity. We're talking about fair value there, say for cash flow hedges. Okay. There it is again. Cash flow from investing activities, payment for investments held at fair value. We use this term quite a lot. Okay. Now, I'm just going to go forward a little bit. Okay, so the word fair value becomes pretty important in most organizations. Okay, and they're talking about things like no debt. Net debt is a statutory measure that includes balance sheet debt and capitalized aircraft operating leases under the group's financial framework. Lease liabilities are measured at fair value. And then if I look at, say, share-based payments, I know that's excluded from the definition, but they give you they actually go to the effort of explaining how the fair value calculation is made. Okay. So fair value, I've just clicked on this quite quickly, but what I'm trying to make the point is that it is really important. Here's the note that deals with financial risk management, and they've actually got a whole section on fair value. You obviously don't need to know that, but what I'm trying to say is that you really do need to know the importance. And this is just a financial statement. On one page, I'm seeing the word fair value mentioned about 15 times. That's how important it really is. So historical cost, we used to talk about that in the past. I think we're going to find fair value is what we talk about in the future. Okay. They've got a superannuation fund. They talk about fair value. Just so much. We could go on forever. Okay. Summary of significant accounting policies. Derivatives at fair value through the profit and loss, and investments at fair value through comprehensive income. Okay. Assets classified as held for sale, they're at lower of cost and fair value. Okay, so there's just so much that is covered in this example. Foreign currency, the list goes on. Okay, so there's a lot to consider there, guys, and there's a lot happening in our financial statements as regard to fair value. Pretty heavy week this week with a lot of information. Please make sure you keep on top of it and that you can attend any of our lectures, the online discussion if you've got questions, but of course you must attend the tutorial. Well, thanks very much. I'll leave it there and I will talk to you very soon. Bye.